Let me quickly show the 0.500 Aqua X Factor, but as I switch, look at the lower right where the lime and purple HMAs are, so you see the changes to a faster speed X Factor. As you see, the HMAs turn more with the pullback, and that is what speed matching is all about. Working at the speed of the market. This setup was in the market the day I prepared the video. Did not show a trade signal, but a no trade. It still served to get you familiar with the three main tools. The Trade Set tool glove fits to the speed of a double move and establishes the speed of analysis. The Pullback tool extracts the blending speed for a new trend beginning and prime retracement. The X Factor family of preset Fibonacci ratios implements signal reading from that market-chosen speed info for a low drawdown, early beginning of a new trend. Even when you get a no trade reading, STAR is still doing its job. This later went on to a new low. Let's look at some screenshots of earlier setups from the last few days. Here's a Trade Set tool for a 5-minute setup. It shows the first stage and the flip and the second stage, then the cut and continuing past the cut, and the trade set is complete. And the box element has drawn to show readiness for a pullback evaluation. We load the pullback tool. It identifies the crosses beginning with 1.000 green. This setup also needed no adjustment of speed, and I said I would show you that, so here's a screenshot of one which needed adjustment, and the tool calculated the setting for us to use. What this is the trade set was bearish, but the force index is showing a counter trend color at the pullback extreme marked by the tool for us of this dashed blue line. And this is to counteract the effect when the SMAs turn with the EMAs, which won't give a good crossing. So the speed adjustment is necessary. The tool has told us that at H4, 0.515 speed multiplier, this will resolve itself. This is actually an H1 setup on here, a different setup from the one we were just looking at. But I wanted to show you what adjustment, what a speed adjustment would look like. So we'll go back to our other setup. On that pullback tool, we were told that the 1.0 green was a crossing pair and some faster ones. And so I've called up the 1.0 X Factor, and you don't have to remember what the other crossing pairs were. It's always displayed for you as a reminder right here along this little color bar. We will be checking for trader-ready conditions, and when criteria have been met, we will take the first one which actually triggers. This X Factor has met criteria and would be awaiting a trigger. I'll now bring up the next faster one, the red 0.764 X Factor. And this is also triggerable and meets criteria, so this is waiting for a trigger. I load the next faster, magenta 0.618. On this 0.618 X Factor, I'm going to point out something to you about the yellow and green shaded areas. This represents the 50% retracement from the trend extreme down here to the pullback level up here, and so that 50% retracement is a couple of things. One is we only take the retracements down into the green zone, and two, if the lime HMA has gone up above the yellow area, then we're not going to be looking at any faster X Factors than this. We are only going to be using triggerable X Factors. We already matched to the trade criteria, including this last one. However, here you see that the purple is heading outside the green zone, so unless the retracement were to come down quickly before the purple leaves the green zone, this will not be an X factor that we could finally still be able to use. That's actually exactly what happened, and the magenta was eliminated. But here is the price trigger on the purple of the red 764. And this is what that same chart saw after the trader. This was a successful trade, but not wildly successful. Star sees more of the great successes than mediocre, but I will point out what is very important to your success. It's our money management and trade handling. It's not exclusive. You may use it with any system. I hope you decide to put it into practice this very day. To start with, I recommend using 3% of your equity as the risk limit for any trade. Now here's what to do. Take the trade as 3 partials of 1%. The stop loss for all 3 is initially set to this trend extreme. Our first take profit is the pullback extreme here. Since the green zone triggers are always better than 50% retracement, the risk reward is always better than 1-to-1. And our conservative first target is usually hit. After that happens, the stop on the second partial is placed at break even. The third partial stop is left where it is for now. This makes your trade no worse than break even in its entirety, and usually better the further into the green zone at trigger. This particular trade got to the next level. The second partial is taken in profit on the first strong move beyond the first take profit point. After this, we get finally into a strong move. This does not need to be defined, and you are completely free to take that partial in profit at any time you wish. That partial can only give profit or break even. No more stressing because of nail-biting questions about how long to leave it on the table. This is because it is the third partial that will be slated for longer runs. Take the second partial on a strong move for whatever makes you happy, because this second partial is the feel-good partial. I like to load the time frame above and just look there to judge it, or you may use straight lines once it has legs, or a trailing stop. Once you're satisfied and take profit on that move, the stop on the third partial will be moved to the point of the original first take profit here, and now you let it run. If the second was a feel-good partial, the third is the feel-great partial. You know it will always be in profit. The worst for that one is what happened on this trade. It stopped in profit. When they run and keep going, you have a nice home run, adding huge profits, while it only ties up to 1% of your equity. We regularly see these rack up pip profits in the hundreds and thousands. There's no fuss over them because this is a routine. The third partial take profit is normally done when you have already had a long run and wish to bank it, and you get a signal from star in the opposing direction. Like it? I know. Promise me you'll implement this handling technique today. Alright, so this 5-minute trade took only 14 pips on the 2 partials at what we call take profit 1 or TP1. And then typically you would take the strong move around in here or so, just based on breaking the upline. That gives approximately 61 pips for this quick turn trade, which could have had no worse than the absolute worst case of stopping out all three partials for the actual drawdown of 6 pips from trigger to trend extreme. Now briefly, let's look at the hunt for setups. What we're looking for is going to be found all over the place because it's a constant feature of market action. We want to find a double move, two movements in the same trend direction, broken in the middle. The completion of all the trades doesn't matter as we can track late-stage development after we find the simple model of the double move. Here we see that we found just that. And in this case, as you can tell, we see that we are still looking for it to finish out and give us our final trade. Now you may use the trade set tool or a blank chart or even a zigzag. I prefer to just look at the blank chart, but this is an easy thing to notice, and it is all around and at different term scales as well. Like I say, it's a constant. Now let's look at another from start to finish. The trade set tool has confirmed the trades at this speed multiplier and marks the main pivot starting point for us. We see the flip in the middle of two distinct moves in the same downtrend. Do not be concerned about the way the market is up and down, because the regulator for everything are precision decimal indicators, and the speed we look for is always the slowest one at which all criteria are met. You and I will always be able to verify the same trade set speed. We standardize our data to a certain reliable feed, and that frees you to use any broker you wish, but always have good analysis data. This has a join trend, so if there are any flags, we will be using a line trader, which usually gets us a better price for entry. Now that all the traits are in place, we will do a pullback evaluation with the pullback tool. This shows that the only crossing EMA-SMA pair within the criteria which the tool checks for us was the plum-colored 0.236, and so after noting that this is a shallow pullback, which did not reach the white dashed MA here, and that sets a depth flag, we will load the plum 236 X factor template and look for trigger on lime. This did trigger on the lime and came very near to the trend extreme, but this is as far as it got. A nice result, bursting 870 pips out of the gate, and it's likely to run some more. Are they all like this? No. Sometimes the market just plods along and we get our pips over a normal span of time. Sometimes, of course, the trade stops out for a loss. In fact, during the same time as this trade, we had a stop out. It was an 85 pip one because that was on a daily term scale, still a low drawdown relative to the term. That was the largest stop in 2 months for our Super Traders Club watch list, and of course stops are in the minority and kept very tight by Starr's methods. The market's not random and is currently building multi-decade Elliott wave formations which exert a volatile force at great scale. Getting trades that get you in early with low drawdown and keep you in the trade to get longer runs requires either buckets of luck and darts or a 21st century approach that works with the very features that build those formations. Ignoring speed changes and double moves, which appear all over every chart, doesn't sound like any method I want to use. How about you? Can you continue using powerful computing tools to perform centuries-old and fairly useless analysis? I thought not.